Let's start off with the new ETF here. I hear the word transparency. I look at some of the members in here, NVIDIA, Enphase, HP, and a few others. What's the common thread that ties all these companies together?
Well, first I should say we have started this ETF based on Paul Pagnotto's transparency metrics. Paul Pagnotta wrote a book called The Transparency Wave and reflected on what happened after 08-09 and what kind of stocks came out of that and have done very well. And it has been those stocks that, or those companies that are very transparent. So 08-09 had a big impact on him. He wrote a book about it. We've looked at the metrics. We are now certified as transparent ourselves in the world of transparency. And we agree with it. In fact, we call ourselves radically transparent. We give our research away. We want to communicate as much as we possibly can with our clients. We want to engage with the communities that we are researching. So we want to share our research with them. So, and it's worked out really well. In many ways, we've gone viral around the world because we're one of the first, well, we are the first sharing economy company in the asset management space when it comes to research. So we think Paul has a very good idea. He's documented it beautifully. And so this index includes the 100 most transparent companies in the world. And it's an equal weighted index.
Hey, Cathie, it's Eric here. What stands out to me with this ETF, a couple questions. How do you determine how a company is transparent or whether they are? Why? There's no banks in here. You automatically eliminate all the banks. I guess what's wrong with them? And then the equal weighted 100 stocks. Is that purposely to give it some zip? Because most ESG ETFs that come out are pretty beta-ish. You're coming out with one that's going to have a lot more volatility, and I guess I wonder if that's by design and just sort of explaining that thought process.
Yes. Well, again, we're working with Paul Pagnotto and his team on the transparency metrics. Of course, they include a lot about disclosure, the reputation of a company, legally and otherwise, and basically the outreach to consumers and businesses. So this scoring system that Paul has and his team have developed, we think is quite sound. It's not been done before. I think we have learned from our own transparency how good a business proposition it is. And so we're not trying to be even ESG. We're trying to be more impact than anything else. Inherent in the scoring is transparency about ESG as well. But we're not calling this an ESG mandate or ETF per se. We do believe it's an impact ETF and that these companies are going to have an enormous impact on the world. And many of them are involved in innovation. In order to grow, companies do have to innovate and be transparent about what they're doing in terms of innovation. So we took a great liking to this index. It's a bit of a diversifier from what we do on a day-to-day basis, and so from a business perspective, a good thing for us to do as well.
Let's take a step back here and look at your overall flagship fund, or all of your funds. One thing that I think people are looking at this year, they've had a lot of struggles. Some of the stocks are down big. At what point do you rethink your thesis for some of these stocks? We see you buying into some of the pain, but for not every call works out. So some of your investors, I think, want to know, is there a time you throw in the towel? Do you have an example of that, or are you looking to do that with any stocks you currently hold?
Yes, what you see us doing, especially during periods where our style is out of favor, which is very unusual in a bull market, by the way, highly unusual, and we can get into that in a moment. But what we usually do is consolidate our holdings towards our highest conviction names. And a lot of commentators noted earlier in the year, during the February through May washout in the innovation space, that we sold our Chinese stocks. Now, in the flagship fund, we moved completely out because we are consolidating or concentrating our portfolio towards our highest conviction names. Now, that turned out to be a very good move. And we've seen that concentration work many times where we've lost some conviction. We still like a stock, would normally sell it, but we like these other stocks better. We have much more conviction in these other names. And those are the names in our top 10. So the Tesla, the Roku, Teladoc, Square, Shopify, and so forth. So that's when we make a lot of those moves. Of course, you saw us sell Zillow recently. It was a little bit of the same. Our style, it has been under pressure. Zillow does something most unexpected, changes the strategy that we thought they had been working towards for 10 years with Rich Barton, the founder of the company, coming back around to execute on this Zillow offers. And then they pulled out. They realized they didn't have the right DNA for it. And so we might have known that ourselves, I suppose, but it involved artificial intelligence. We thought Rich Barton was right there, was on top of it. So we did sell on fundamentals, that particular name.
Talk to me when you talk about investing in some of your highest conviction names. It does create concentration risk, not only with a single stock as much as 8-9% in a single ETF, but that name repeats itself in many and several different ETFs. How are you thinking about concentration risk when things do move to the downside?
Yes, what we are usually doing in a bull market, and you saw us do this last year, is as a bull market extends, we actually diversify our portfolio more and more, putting in names like the FANGs, which we consider more cash-like instruments in our world. We're much more focused on the innovators of the future. So you will see us do that, and that's what we use to concentrate our portfolios during downturns. Now, why do we think it's such a good idea to concentrate during downturns? Because most of our counterparts are doing the opposite. What they're doing is selling our stocks. Our stocks either are not in indexes or they're very, very small parts of indexes. And so when traditional asset managers are managing their portfolios in a risk-off situation, they're diversifying to get closer to their indexes. They're buying index stocks and they're selling our stocks. So we are there to pick up the pieces. And it usually works out very well. I will say that this risk-off period, which started in February and is still in force, is a very unusual one for us. I've never been in a market that is up, has appreciated, and our strategies are down. That has never happened before. And in fact, the disconnect is even more strange when I look at the up rounds taking place in the private world when it comes to innovation. Nubank comes out today. I think it had an up round this year that
so then
doubled.
Sorry for interrupting. Do you then change your strategy? If you've never seen this before, where there's an appreciation, but your strategy isn't working, do you change your strategy?
We have a 5-year investment time horizon. Our strategy is our strategy, and we believe that truth will win and in the end. So we think the opportunity in our strategy is huge right now. In fact, rarely in my career have I seen our 5-year projections for returns, compound annual returns, hit 40%. We believe, based on our estimates, now they could be wrong, we don't think so. We think we have the best research when it comes to innovation in the industry, very high degree of confidence as it is centered around Wright's Law. Based on our very disciplined research, we expect a compound annual rate of return of roughly 40% over the next 5 years. That's a quadrupling. At the peak of our strategy in February, that number was 15%. That is our minimum hurdle rate of return. When we go through a period like this, of course, we're going through soul searching, saying, are we missing something? And we double down on our research and we double down on our modeling. What you should also know is to get to that 40% compound annual rate of return, we assume massive multiple compression from today's levels. If I can just finish,
Sure.
one of the reasons our multiples are so high right now is our companies are investing aggressively to capitalize on the 5 innovation platforms involving 14 technologies that we believe are going to scale exponentially during the next 5 years. And so we assume that the valuations are going to compress to FANG-like valuations. So it's a serious compression of multiples assumed, and we still get to that 40% compound annual rate of return.
Cathie, I'm really curious about the impact of higher interest rates. We've seen some of the growth names just generally really waver in anticipation of higher interest rates. I would love some specifics from you on how you think that some of your investments might be impacted.
Well, I think they already have been. I think that's what started in February once vaccinations were hitting critical mass, or we could see they were going to hit critical mass, and we were going to get back to work. I think everyone was working very hard, but back into the physical world. And so this assumption that the Fed was going to tighten started to make its way into the market. I think that's one reason many of our stocks are down. Some of them are down 50 to 60%. And what we see happening today is the flip side of, well, it's a little bit like what happened during the coronavirus. As we entered it, there were algorithms out there. And this market is, I think, controlled by algorithms in the short term. And so what happened in the short term as we went into the coronavirus is algorithms seized on 2 variables. How much cash do companies have? And are they burning cash? Those 2 variables took some of our stocks down 50, 60, 70%. And those who took those stocks down, the algorithms, the momentum players, the obvious trade, those people were all wrong. Those stocks were some of the biggest rebounders because, especially in the genomic space, the genomic revolution helped us get to that vaccine and to those tests much faster than what would otherwise have been the case. Today, what do we have? We have algorithms focused only on the valuations of stocks today, maybe trailing 12 or maybe this year, very short term. So they are thinking, okay, high interest rates, kill those stocks. So we think it's already taken place. And by the way, and I think, Taylor, you mentioned this earlier, interest rates, after Chairman Powell said, maybe this is not transitory inflation, the bond market rallied. And so I think the bond market is saying that point of view is incorrect.